Welcome back in, everyone. I hope you're having a good day today. Here recently, I've been doing a lot of thinking about my portfolio, about my watch list as well, where my money is allocated, and I'm starting to think that I might need to make a change here, maybe two. But recently, I've been looking at my investments in these businesses that I'm investing into, and I'm looking for reasons to say no to the investment. It could be something as simple as emerging competition. It could be poor capital allocation within the management. It could be a weak moat that maybe a moat that I overestimated or underestimated. In either way, I'm having that concern here with Robinhood. My thesis was that Robinhood is pulling in all these young users, getting them onto their platform, putting their money as like their retirement accounts, they're moving into banking accounts, they're doing all of these things, trying to get young people onto the platform. So over time, as younger people, they earn more over their lifetime. And over time, the amount of money that's on Robinhood's platform that they're going to be able to make money off of gets bigger and bigger as these young people start to make more money and save more money and invest more money. But at the end of the day, I've come to the realization that in today's day and age, in such a fast tech world where I just don't see switching cost as a very supportive moat around the company. And that's one of my biggest struggles is like, for me personally, I had Robinhood years ago. I switched to Charles Schwab because my mom was like, hey, I think Charles Schwab is safer, blah, blah, blah. I switched and then I went back to Robinhood as my brokerage because I got the transfer bonus. It was like 2 or 3% on my Roth IRA, whatever it was at the time. And so just thinking about that experience for myself personally, I just don't see how the switching costs from, keeping people on the platform or from switching to competitors is going to be that sticky over a long period of time. This is a very competitive space. They're already fighting against companies like SoFi and plenty of other brokerage that offer very similar products, and they can always do these one-time bonuses or one-time transfer bonuses. Same thing that Robinhood did to get these customers. So I have a fear that that's something that they're going to face a lot of trouble with in the long term. Um, Another company that I'm very weary of is PayPal. The valuation now is almost so cheap for it almost can't fail at this point. It's like at an 8 price to earnings, and it's still growing revenues, even though it's not very fast. But the company is so free cash flow like accretive at this valuation, it's very hard for me to make a bear case for it. But there are plenty of concerns with the company, mainly competition. They're having to fight off Apple Pay. They're having to fight off Google Pay. They're having to fight against Visa and MasterCard and so many other payment platforms. And their Venmo segment, they're fighting against Zelle. They're fighting against Cash App. They're fighting against so many other ways to transfer money. There's so many different competitors in the space. And PayPal, it does have a very, very strong brand. It's one of the safest, most secure ways to pay for and move money around on the planet. But it just has so much competition. And there's so many big players that they're having to go against. I mean, Apple is a huge company. Google is a huge company. Visa and MasterCard are huge companies. These companies could simply take away PayPal's business without even making profits because they have other business segments that are making so much money. So that's a huge risk to PayPal. Although I do think the company's going to be okay. I think it has staying power. I think it has, a really strong brand. Funnily enough, in the financial space, I believe it is probably the strongest brand within all of those payment companies. With that being said, that is another one that I'm a little bit weary of. The other ones I feel pretty good about. I'm sitting here, I'm asking myself, I'm running through a checklist. All right, does it have a wide moat? Does it have switching costs? Does it have network effects? Does it have a brand? Something that keeps competition away from coming in and taking the business away from them. If they do that, I move on. Okay, do they have some sort of pricing power? Do they have strong capital allocation within the management team? Things like this. Is management aligned with the direction that I think the business should be going? And I think the rest of my portfolio checks off every box for the most part. And you have to take into consideration the valuation of these companies too, which none of my companies are valued very highly as of today due to this market sell-off. Like Adobe is dirt cheap. I believe this is probably my favorite buy in my watch list, or sorry, in my portfolio. But I just simply can't continue to add to the position. I don't want it to be, a 25% position. That's too much concentration for me. But there's so many of these companies were once high flying companies, and I had been following those companies like S&P Global. I thought this was one of the best business models that I've ever came across. And it was just so expensive. And so I sat there, it sat on my watch list for over a year. And then finally I get the chance to enter. So that's why that one's in the portfolio now. Same thing with MasterCard, same exact story. I thought MasterCard was possibly the best business model in the market. It was so expensive. Now it's trading almost at the same price as the S&P 500 overall, which is insane. Same with Google. Had a great opportunity last year to add Google. Now Meta's now trading at a discount. So many of these companies are very high quality companies. And that's the key for me. I want to find the highest quality company that I can find, a company that I understand, a company that has a wide moat, a company that has pricing power, a company that I believe is going to grow and print free cash flow per share for a very long time in the future. If I can't predict that long term, it's not something that's really for me. And then I just want to sit there and wait for a good entry point. So let's take a look at my watch list here. I have roughly 30 stocks, I believe, on here. Yeah, I have 33. Some of these will be weeded out. I add companies here and there, and the more I research into them, like I said, I'm looking for a reason to say no. So if I find a reason to say no, then I will eventually get it off of the watch list. I'll put it on a different one, and I'll just watch it from afar and see if that one thing that I ever said no to maybe changes, or there's a, some kind of evolution within the business that changes things around. But there's so many companies that I have weeded through. Like, I see people online talking about quality companies all the time, and I get to doing research on the company, and there's always just one or two things that sticks out like a sore thumb that I just can't get near. It's something, either I don't understand it fully, or it's something that I see differently than the public in general. But there is a few today that I'm really considering. Like I said, I'm a little fearful of Robinhood and PayPal, especially Robinhood. But there's a few companies now that I believe are probably a better place for me to put my money going forward. One of those is, where is it at? Right here, MSCI. MSCI is a index fund company, essentially. They have other services, intelligence services, similar to S&P Global. But their biggest business segment is their index funds. And they, if you invest into VTI or any of the worldwide index funds, you're likely putting it into an MSCI tracked fund. And what happens is, as the amount of money that's put into these ETFs goes up, and as the market goes up, so, if the world puts in, whatever, $1 trillion into MSCI index funds, they take a percentage of that $1 trillion. But as the market runs up, more people put in, and the market runs up, that number, that trillion, goes to 1.1, 1.2, 1.3, 1.4, and they still get the same percentage. So they have to do no more work, and that money, their profits continue to grow. So it's very, very, and you'll see that in your ETFs. Like I own SCHG, which is an S&P Global ran index fund, which is another reason that I don't own this company, because I already do have exposure to the index business. But I wouldn't mind a little more. That's like 15% of S&P Global's total business, I believe, in terms of revenue. But MSCI, like I said, it's so concentrated, and I like that because there are some risks within S&P Global. I don't love like the commodity business and the market intelligence business. They're nice businesses, but they do have more risk compared to their ratings and indices business. But MSCI is a much more pure play, and now the valuation is getting very cheap. Let's take a look here. It was actually very cheap, I believe. In December, I believe we had a nice dip. Yeah, right here. It dipped down to, or no, that was this year. Okay. Nonetheless, you get the point. Here in February, we got it down to $510. Today it's at $544. It's not that much more expensive, but it's a very, very high quality company. And now you're getting it close to a 4% free cash flow yield, as well as a 35 trailing 27 forward PE. So it's not screaming cheap. It's nothing like Adobe. It's nothing like Meta. But I believe this is a very high quality company. As you can see here, the retention rate is in the 90s, and it's getting better over time. Index funds are getting more and more popular, and I think that's going to continue to happen in the future. But look at this chart. This is the revenue. It's just so straight up and to the right. It doesn't matter. Like, you can even find 2020. Like, the whole worldwide economy shut down, and they continue to grow revenues. Where's 2008? Here's 2008, the financial crisis. It never, no hiccups. I don't know if it ever went down ever. I don't see a time period at all here where the revenues went down. So it's a very, very reliable company, very safe, super wide moat. I think it's one of the widest moat companies that I follow personally. So this one I'm heavily considering here. I would like to get it a little cheaper, maybe under $500. You never know what could happen, but I'm eyeing this one closely. Another one that I'm looking at here, I really like ASML. I've liked it for a while now. I was looking a lot at it last year when it was around $700. And then by the time I decided that I was comfortable to buy the company, I had already ran up to like $1,000. So I was just like, I missed most of the train here. I'm gonna give this one some time, and hopefully I can find a time to buy back into the company. As you can see here, it's at a 46.5 trailing price to earnings. 2.4% free cash flow yield is not too bad for the wide moat that this company has, but it's a true monopoly. It's one of the true actual monopolies that I have ever found in the world. Another one is Synopsys, very similar to ASML, not quite the run up though. But another company that I really like here is Intuitive Surgical. This is the company, it's growing very fast and it's growing exponentially. I'll go over that later. But this company is basically the leading robotics play for surgery. And they have AI integrations now. But what they do is they sell platforms. They're Da Vinci platforms, and it helps surgeons do surgery with special tools as well as special graphics and different computer systems that help them make better decisions during surgery, and they're much more efficient. The numbers show they are much more efficient when they use these platforms. The Da Vinci platforms cost millions of dollars. I believe they're like $2 to $3 million per unit. So the switching cost on that is incredible. Once a hospital puts in the Da Vinci unit, they would much rather pay for the service and the any updates, service. The utensils that they use, often some of them are very like they have to be replaced quite often, and you have to buy that from Intuitive Surgical. So it's like a razor and blade model that they're selling. The platform is the razor, and the tools that they have to continue to repurchase from Intuitive Surgical is the blade, like if you're, Gillette or whatever. But that being said, this goes up. So as the more platforms that they install in different hospitals, and just to mention, they're the leading market share. I believe they have like 60+% market share. It might even be around 80%. I don't remember off the top of my head. But they are monopolistic in this space. They're ahead of everyone. They have the best service. And they have now, in their newest models, they have AI integrations that are definitely helping out. And it's kind of like a Waymo, where if one car messes up or one car does something wrong or right, it tells every other platform. So it's like a hive mind, essentially, within all of their platforms. So it's very, very high tech, high quality company. They do have to invest quite heavily into research and development, but that's going to happen. The only problem here is the price. And we're getting a discount here. I mean, past 1 year, it's negative. Year to date, it's down 20%. And 77% for this company over the past 5 years isn't that much when you look at the revenues and the free cash flow growth and all that stuff. So, but we definitely had an opportunity here. I was looking at this here. I was looking at it at 430. And now it's back down to about 452. I really want to buy this company, if I can, somewhere under a 50 trailing price to earnings. Like I said, it's one of the widest moat companies I've ever seen. And look at this. This looks almost like MSCI. You do have a couple downturns. I'm actually not sure what this 2013 one is. I don't know if they made some changes within their install base or whatever that was. And then you had the COVID dip here, which is understandable. But other than that, over the past decade, revenues have grown at almost 16% per year. And look at this. They're accelerating. That's what I'm talking about. So they're installing, about roughly the same number of Da Vinci systems per year, which widens their moat. The more hospitals and locations that they get into, the stickier the whole ecosystem is going to be for the whole healthcare system here and internationally. But like I said, they have the service cost and update cost and maintenance cost. So that's recurring revenue on top of the millions of dollars that they get per unit that's installed. So this is going to continue to go up because they're going to continue to sell new systems, and over time that recurring revenue is just going to continue to climb exponentially. So I expect this to be 21, maybe 22% over the next 1 year, at least in this 20.5% range. And we could even see this, eventually top out somewhere around 25% year over year revenue growth in the future for this company. Outstanding balance sheet. So you're paying $160 billion for the company, but they have $6 billion of cash on the balance sheet with only $130 million in debt. So you're actually paying, how much was that? So you're basically paying $155 billion for the company. That makes the valuation look a little bit better, not too much, but you're probably paying like a 53 EV to earnings. Same thing, you look here at the net income. It's a little choppy, as earnings always are. You have tax hits and things that, balance things out over time, but it's still past decade 17%, past 1 year 23%. Same thing with free cash flow. Over the past 10 years, up 13%. It's very choppy as well with earnings, as they are. This is very fake. Obviously, they had a dip here. So it's not going to grow at 90%. That's not real. That's not going to happen. But you see earnings per share. This is basically what the net income looks like. They're not very dilutive. I mean, there are some sorts of dilution, but they're also buying back stock whenever they believe that the company's cheap, which they are doing here recently. So when we look at the valuation over the past 5 years, on a price to earnings, it's almost as cheap as it's been. Here in 2022, the earnings dipped. So the forward price to earnings was probably not even this cheap, but it's relatively about as cheap as it was at any time point in the past 5 years. Here's the free cash flow yield. Like I said, here in 2020, free cash flow also dipped. So this is not it's probably about as cheap as it is here now. So I think this company is starting to give a nice price to entry. And this is what you like to see here. Obviously, over time, they're going to have to spend more on reinvesting back into the company, whether that's CapEx or research and development. But here recently, it's actually backed off. That's really lovely. That's going to help their profits a lot. That being said, this is one of the high quality companies. One of the widest moat companies I've ever seen here is Intuitive Surgical. And we're starting to get close to a nice entry point. Like I said, right around $400. I'm probably going to have to pull the trigger, but we're still going to have to fall, another, I don't know how many percentage that is, 5, 6, 7%. So, and there's a couple other, let's take a look at one more. I talk about this company almost every single day on X, Twitter, whatever you want to call it. I've talked about it in some videos in the past. Copart here, I think this one is so misunderstood. This is a nice company that if I were to add it to the portfolio, it would be a non-tech play. So they have some tech aspects, like their auction platform is tech, of course. But this is one of the widest moat companies, like especially a physical, like almost a physical seller company, not a tech company, that I have ever came across. I looked at the company years ago and I saw the valuation. I was just like, I'm going to save this for later. But over the past 6, 7, 8 months, I've been looking at the company a lot. And look at what the share price has done over the past 6, 7, 8 months. It just gets cheaper and cheaper. The more and more I learn about the company, the cheaper it gets. The reasoning here, you're seeing this revenue start to go down here. And the reasoning for this, from what management is saying and from what I can, I look at the information from their reports, from what I'm getting at, is they're having a decrease in revenue for 2 reasons. Actually 3 reasons. One is they had a very weak cat season in 2025. Cat is catastrophic weather, whether that's hurricanes, tornadoes, earthquakes, whatever causes a lot of damage to cars, hail. What happens then is if there's big storms, these insurance companies get a lot of claims at once, and they have to send like a lot more than normal vehicles to lots like Copart's or Ritchie Bros, which is the other competitor. Copart's the biggest player, but the Ritchie Bros is like the Pepsi to Copart's the Coke. But so yeah, they have to send all of these extra units to Copart's lots, and Copart gets more. They charge additional fees for catastrophic storage holdings, and they get a lot more revenue when there's weather like that. So there is some randomness in the business. As you can see here, there's a couple times in the past where revenues had dropped. Here in 2020, here in 2015, I'm sure a similar thing happened here. Here in 2008, that probably had something to do with the economy. And here back in 97. But needless to say, so that's one of the reasonings. Weak cat season in 2025. Number 2 is the consumer. Insurers have came out and said that total loss, consumers that are getting total loss policies was decreased over the past year, at least in 2025. So that is going to mean that some people are going to have collisions and they're not going to be insured for total loss. So that's not going to be on the insurance company to send that to a lot like Copart to get it auctioned off. So when the consumer is very weak, you're going to see less total loss claims, which is less revenue for Copart. And the third reason is there was a few players, mainly one. It was mainly Progressive. So Progressive, as I talked about, Ritchie Bros is the competitor to Copart, the only other main competitor. They're the only other company with lots similar to Copart internationally and around in the United States. But Progressive already sent, before last year, they already sent roughly 75% of their business to Ritchie Bros. They like their, something within their system that they like more within the auctioning off of the cars. I think it's more transparent over there at Ritchie Bros. but Progressive likes them more. They were already doing 75% of their business with them, and as of last year, they ramped that up to 90%. So there's still about 10% of the business that they probably can't get to RB Global, and they have to send it to Copart. But that's something that it's almost maxed out. Progressive is already basically not a customer for Copart, and at this point, and the reasoning that they're getting the switch from Progressive, like I said, there's some transparency, but it's also pricing. You've seen RB Global's margins go way down, meaning they're lowering pricing to try to get probably Progressive and a couple other players. But they can't continue to do this for a long time, or they'll hurt both businesses, and they just won't make a lot of money. They're already a lot lower margin than Copart. But that's the main reasoning. You have the Progressive switch, you have catastrophic weather being very slow in 2025, and you have a weak consumer for insurance claims. So all of that combined with the fact that Wall Street is seeing Waymos on the street. You see them online. You see them in, I believe they're in Texas. They're here. I live in Georgia. They're in Atlanta. They're in San Francisco, I believe. So they're around. And people are seeing autonomous vehicles. And the thing is, people think that autonomous vehicles will eventually, be every driver on the road, right? Which is probably that's a fair assessment. But I just don't even know if that's going to happen in my lifetime. I don't know if it's going to take 20 years, 10, 15, 30. I know it's not going to be less than 10 years. There is no way that every person that has bought a car, people are buying cars today, right now, brand new cars. They're not just going to get rid of those for autonomous vehicles. I do think there will be a transition, but Copart is also international. And currently, the U.S. is the biggest market for AVs. I don't even know if they're in any other countries, to be honest, but I know the United States is the biggest, has the highest concentration of autonomous vehicles on the roads so far, and they currently account for 0.004% of the amount of miles traveled in the United States. So they have a long way to go. And autonomous vehicles, until they're the majority of cars on the road, they're going to be in collisions, and they're going to have problems. They're going to have, malfunctions within the engine. And another trend is all these cars, the repair costs for cars continue to go up and up and up and up and up. It seems like every single year. So as that climbs, the amount of total loss claims from insurers will go up. So that's another tailwind for Copart. So I just see so many tailwinds for the company, combined with a huge sell-off due to a multitude of factors that I believe don't pose a serious threat at all to the business. And this is the one that I'm really, really heavily considering adding into the portfolio. I'm thinking of selling Robinhood, and as well as using some of my new deposits from my income. And I'm thinking of starting a position here in Copart. I believe it's a steal here. Under $40 is a steal for the company. It's close to $30 now, but you're getting it at a 20 price to earnings. It's an irreplaceable company. You can't replace it. It's highly regulated lots that they have. You can't get them, and they own them. They own about 90% of their lots. RB Global, their biggest competitor, doesn't own, I don't even believe they own half. I believe they lease most of their lots. That being said, so you're paying a 20 price to earnings, 21. You have $5 billion in cash, zero debt. So you're paying $27 billion for the company. So you're basically paying probably an 18 EV to earnings here. That combined with their lots, this doesn't account for the price of their lots. That's in the book value. The book value for this company is over $10 billion. So if you include their balance sheet, their lots, all their other assets, you're paying for $20-ish billion for the future profits of the company. So if you're paying $20 billion, a company is doing $4.6 billion in revenue. They're doing $1.4 billion every year in free cash flow. And look at the growth of this company over the past, this is one of the best compounding machines in existence ever. Over the past decade, they have compounded free cash flow per share at 26.4% per year. That is insane. Over the past 1 year, even with the deceleration, they've had margins expand here, which is nice. Over the past 1 year, 38%. I'm not expecting this. I'm not expecting even this. But let's do a DCF here. What we're trading at, and they have almost no stock-based comp. So let's do Copart DCF. Let's say they grow free cash flow per share. Historically, it's been in the 20s. Let's say they grow it at 12%, right? Nothing crazy, 12%. And we trade it at a free cash flow yield. Remember, you have to take into things like the book value and the balance sheet of the company when you look at the valuation. So I think with the size of the moat, with decent growth for this company, and the fact that they have a dynamite balance sheet. This company is going to trade around a 3.5% free cash flow yield. Currently, it's at a 4.3, but as we've seen, it's in a huge sell-off. People are very worried about Copart. If you get just these very, very, average assumptions here for Copart, they often trade a lot lower than a 3.5% cash flow yield, which is a more expensive company. And they also grow free cash flow per share a lot faster than this historically. You get 17% returns per year for the next 5 years. This is dynamite. And I believe this is very bearish for the company. We can even do 8% and they trade at a 4, and we're still getting, we're probably beating index funds here. So I think this is about as bad as we could get here. Maybe this trades at a 5 and you get 5%. I think this is probably the worst it could get. But let's say we grow at 20%. We won't even go that high. We grow at 18% free cash flow per share, and we trade at a 3.5. You're getting 23% returns per year. I believe this is going to be a great investment. I keep looking at this one, and I don't know why I don't own it yet. So this one's probably going to join the portfolio here soon in the coming month. No guarantees yet, but like I said, I'm eyeing selling Robinhood. I'm eyeing possibly selling PayPal, and I'm eyeing, putting my new deposits into a position in Copart, because my other favorite bets in the market right now are MasterCard, which I have about 16% of my portfolio. Adobe, I have about 16% of my portfolio in. And Meta, I have about 16%, 16% of my portfolio in Meta. So I don't really want to add to those. Another company I'm thinking about adding is Visa, which I don't think this will really differentiate me much from Meta. So that's my only hesitancy there. But this one is very cheap. As you can see, here's the 52-week range. It's very cheap, $300 per share now. This one's just gotten hammered. For the quality of this company, over the past 5 years, it's only up 37%, and they've grown free cash flow per share 22% per year. So it's $12 per share here in Q4 2025. Q4 2020, it was $4.32. So they've tripled free cash flow per share, and the shares are only up about 30%. I think this is another great opportunity. I'm not going to go into too much depth here with Visa, as I already own MasterCard. I talk about MasterCard all the time on the channel. But there's a few opportunities here that I just wanted to let you guys know that these are what I'm thinking about. I get a lot of feedback asking why I'm buying and selling things. I don't trade much, as you can see. Once I started this channel, I started it right after the new year here. And I actually haven't even sold a single position yet. So Robinhood and potentially PayPal will be the two companies that I likely sell out of first. And I've only added a few positions. I sold out some of my ETFs. I had a lot of money, roughly 20% of my portfolio, maybe 15% in VOO. And I transitioned that into some new opportunities that I saw last month, including Intuit, Uber, and Spotify, 3 companies that I'm roughly flat on the investment so far. But just wanted to give you guys some transparency, what I'm thinking about, why I'm probably going to start a Copart position here, maybe an Intuitive Surgical, and maybe an MSCI position as well. But that's what's been on my mind lately. I hope you guys enjoyed. Make sure to drop a like and subscribe on the way out. Let me know if you have any thoughts on these companies down below as well. And you'll have a great rest of your week. Thanks for watching.